All right, Eel Nerds, episode 144, and this one is a very interesting one. It is a long-term scorecard of whether the Eel Nerd philosophy works or not. I've already given you the suspense. Yes, the strategy matches or beats the NASDAQ and the Dow for all of 2024. I'm going to show you how I did it. That is me in a ragtag jeans and dirty t-shirt beating all the high-tech people, trading in crypto and AI and Bitcoin and all the fancy stuff. I will show you how I did. Well, we're up to 391 something subscribers in 2 years. Thank you for your support. If you are new, please use the playlist, which begins from a beginner level. Most importantly, do not believe me. Check your own work. Make sure you use your own common sense. Well, we start by taking the market temperature to see where the market is, and I will show you my scorecard of how I played these fancy people who trade in the NASDAQ. And then we'll talk about the potential divergent paths ahead. And I thought I would take it as a good moment to give advice to the 25-year-old me, the 40-year-old me, and so on. And remember to translate that into your world. I don't know your world, but I'm going to explain what I would tell my own son or daughter when they are 25, 40, and 60. And finally, I'll review my trades. Before I go too far, I want to make sure you understand I am sharing my education. This is not investment advice, not tax advice. I don't do politics and products, and I am not a wealth management advisor. This is not snake oil. Well, let me take a very short victory lap. As you may know, if you've been following this show, I only have a tiny allocation on equities. But hey, that is my portfolio, just the equity portion, not the fixed income, just the equity portion, returning 23.24%, obliterating everything else. And here is my portfolio against the Dow. I smashed it by 6%. Here it is against the Russell, crushed that by 5%. It took me a while to check and double check, and what I realized was the nature of volatility. Let me explain what I mean by that. Here is the NASDAQ increasing tremendously in this time period. My portfolio also increases, but it doesn't increase by a huge number. It just gently increases. Here is the NASDAQ crashing by an enormous amount. Mine barely registers a blip. And again, from around September, here is the NASDAQ increasing. Mine also increases. And so the moral of the story is when there is an upside in the NASDAQ, my portfolio captures most of the upside. When there is a downside, it captures very little of it. That appears to be the secret. It doesn't mean that I can rinse and repeat it all the time, but compared to the Russell, the NASDAQ, and the Dow, it looks like I keep pace or beat them. And the main thing in terms of humility to remember is this could all just be an accident. This could all just be because it's a broken clock that just happened to be right this year. So let me explain my philosophy behind why I pick the equities I pick. And the first thing I would say is, and I hate to be capitalistic here, I look for companies with a very big moat. Warren Buffett calls it a moat. In reality, they kind of sort of behave like monopolies because they have pricing power. Cal-Maine Foods, USLM, a company that sells lime. How low tech can that be? But in the markets where they are, they dominate and there is no other good competitor. Fix, which is really a company that does HVAC and electrical repairs, they in the Southeast dominate. There are very few people who can compete with them except a mom and pop shop, but you really can't trade the mom and pop shop. I also look for companies that are profitable. I don't take the huge risks of the AI and companies that make enormous losses, but there is this pipe dream in the future. Saya, for example, is a trucking company, one of the very few truckers with low or no debt, and yet they are profitable. They are able to increase their rates of 1 ton per truck mile as they measure it in that world when the rest of the industry decreases it. Very interesting company. And then goods that cannot be substituted. Republic Services is a landfill company. Again, as low tech as you can get, but they have pricing power. Nobody can mess with them. Mueller Industries, these guys make tow trucks. Find another company that manufactures tow trucks, and I'd like to talk to you. The point is, when you find the convergence of a monopoly or a near monopoly that is also profitable, has low debt, and has pricing power, and is an essential good, that appears to be the secret of beating or matching any of the big indices. And I will tell you how I did that shortly. My allocation, for those of you who are new to the show, it used to be a minuscule 0.5%, and now it is up to 3%. And even with that kind of a really tiny allocation in the equity portion, which is the orange bar here, or orange slice of the pie, my equity portion absolutely demolishes the public indices. And so I am trying to slowly but surely move into equities with certain assumptions that I will review. Um, all of you know that most of my allocation is in treasuries. I do have some corporate bonds, more on the long duration end. And in terms of credit rating, I do not mess with poor credit. Practically 82% is in short-term treasuries, which shows up as cash. And the rest of it are all single A, double A. I just don't mess with the below BBB, not my cup of tea. In terms of duration, I keep most of mine in the short term, and I am expanding duration. I'll talk to you more about it. And so my entire portfolio, if you were to merge fixed income and equities, is not 23%. It's more like 5%. But I'm very happy with that. 5% return on my total portfolio covers my expenses and then some. But I suppose I can get a lot of hubris and say, since I'm such a genius, maybe I should have moved all of my allocation to equities or just an index. The truth of the matter is, the return of just the pure index is significantly more than the paltry 5% that I made. And you can pick any index, S&P, NASDAQ, Russell. And so you could make the argument, Badri, now that you know how to invest in equities, shouldn't you be throwing everything you have at it? Because you can then keep up with 20% returns. Why are you satisfied with the 23% return only on 3%? And I will explain my thoughts and my dirty shirt chess playing with the smart players. Uh, I believe there are three divergent paths ahead for the economy. Let me explain. I'm going to take the yield curve to explain it. About a year ago, in October 2023, that was the yield curve. Short term, you got 5.5. Long term, 10 years, you got almost 5%. That's insane. And September 2024, roll forward, it kind of completely crashed as Chairman Powell started dropping rates. Ironically, since then, the long end has started moving up. So what is the story the yield curve is trying to tell us, and where is it likely to go? Because that has a lot of implications on the equity side as well. And that is the reason why I don't go put 30, 40, 50%, or some would argue 70% in equities. I have my own reasons. So let me kind of sit here and do my own forecast. Please remember to do your own, and do not believe me, do your homework. There are a few paths that this can go. To kind of recap, 12 months ago, 2 months ago, and here is today. If indeed we've entered a new bull market where everything is hunky-dory, in theory, the short-term interest rates would have been dropped because the government is trying to stimulate the economy. The long term would also drop instead of going up, and we will have an uninverted yield curve. That would be the bull forever, the beginning of a new era. We're still taking on more debt, but hey, what's a little bit of debt? What's a lot of debt? America is the champion. Interest rates drop. Stocks are going through the roof in this scenario. This is the bull forever. Unemployment stays low and inflation stays low. Tax revenues are surging because companies are making money. And somehow, even though PE ratios are already at an all-time high, company earnings go up. Inflation is tamed. This is the world's greatest soft landing forever. Kumbaya case. Now, you could argue between 2009 and all the way until 2020, before COVID came on the picture, this kind of was what was going on. We had unfettered growth and the market was just going nuts. If you have reason to believe, you do you. If you have reason to believe we are in the bull forever market, then you are making a mistake in staying in the short run, because the short term durations are going to keep crashing. The long term is also crashing. You should jump to equities all in. That is what this would tell you. Let's talk about the black swan. And I hate even talking about it, but that is something that could happen. Now, what is a black swan? It could be something like what happened to COVID. Here we are a year ago, here we are 2 months ago, here we are today. A black swan would look like that. Something completely unexpected. It could be World War III, which I hope never happens. It could be another COVID-like situation. It could be some other unrest. When something like that happens, then there is an enormous drop. The inversion in the yield curve will go away, but across the board, there is a very low yield. And so in that scenario, long-term rates would be higher, except they're not going to be higher than today. Equities would be crashing. It would create a buying opportunity. There is global tension. Debt increases even more, even though interest payments decrease. So there may have to be stimulus. Debt to GDP becomes even worse because GDP is going to be lower in a black swan case. And here is the interesting part. In such a scenario, if you were the genius who bought a whole bunch of long-term bonds that paid 4.5%, 4.8%, in yield, imagine what that would trade at if the new yield is 1.5%. Remember, during COVID, the yield was 0.5%. You would be sitting on treasuries that would trade at $130 on $100 par. You would look like an absolute genius if you indeed went on the longer duration and the black swan happened. Nobody knows whether it would or not, but that would make that case. Well, there is also the other point of you could force a recession. What does that mean? Instead of decreasing interest rates, which everybody expects the Fed to do, the Fed says, I can't do that. I'm going to keep short-term rates high because we expect a recession. Now, if you kept short-term rates high, companies cannot raise money, mortgage rates stay high, home purchases go down, the long term becomes even higher, and this creates a recession. And everybody has been calling for such a recession even a year ago, and that hasn't happened. But, you could argue if tax cuts are enacted, then tax revenues will not be enough to pay the interest rates that we need to pay. Therefore, we need to issue new debt. Debt to GDP goes even worse, which kicks up the long. So that would be a forced recession. We can't cut spending. We throw tax breaks at it. Company earnings go down because the cost of debt is passed along to the customer, or some of them cannot pass it along to the customer. And the manufactured recession creates a big problem. If this happened, then equities would be crashing. The challenge with the manufactured recession is it's not going to be a 2-month recession or a 3-month recession. It could be a couple, 3 years, kind of like between 2008 and 2011, and then the market came storming back. But in that scenario, you had to have bought at the right time, and you would have been waiting on 2, 3 years to see your opportunity. So where does this all take us? I would say if in the bull forever case, the black swan case, in both of those cases, you can see that the long end has dropped. The only case where the long end increases, the bull steepening, is a forced pain scenario. And the way I look at it is if my target, which is 5% pre-tax, if you can give me 5% pre-tax on the long end, I'm going to allocate a whole bunch on the long end, meaning I will increase duration once the long end reaches a target. Now, in the meanwhile, I'm going to keep shopping equities, but I'm not going to buy equities because I believe in kumbaya. I hate to say this, every one of these 3 cases, forced pain will take the equity market down. Black swan will take the equity market down. So 2 of the 3 takes the equity market down. There's only one, which is the bull forever and ever and super soft landing. And you believe what you want to believe. I don't give that an enormous odds, but in both of those scenarios, my instinct would be to buy equities at a very good price. If I don't find it, I'll just sit and wait, but I would extend my duration because in the long run, that's the only scenario that will give me fixed income returns. Now, in the other two cases, where it's forced pain or black swan, I would jump to equities and stay in short-term treasuries because there is a market crash here and there is a market crash here. So it appears to me that my strategy, informed by my thesis, would be to stay on short-term treasuries, have a barbell where I do allocate some to the very long end, and in the meanwhile, slowly but methodically go towards a 15% equity target. Now, why do I throw these numbers? And I thought I would kind of stop there and talk to a 25-year-old kid, 35 or 40, 45, 50, and so on. And there is a reason why I picked these age brackets. And the picture you're seeing here is Yield Nerd's YouTube analytics. And what it shows is that, thank you for all the viewers. I have some level of people between 25 and 34, very early in their career, and a little bit more in the 45, and most of them in the 55 to 64. So I thought I would pretend to be each of those ages, or I would talk to each of those ages. If I were them, what would I do? And please make sure you apply your own judgment. But if I was this wonderful looking young man who was 25 and my wife was hanging with me and I was allocating my money into the pie, and I had this fancy car, a very nice job, and I lived within my means and I was able to save 20% of my income. Maybe out of the 20% of my income, I wouldn't put all of them in the investment side. Maybe I'd take some of it, buy a house, maybe some of it take something else. But if I were to put 5% in the market, my advice, you do you. I wouldn't put anything in a 401k, in part because you don't get to control it. There is no self-managed 401k, if you will. Someone else manages it, and that's not my cup of tea. I also don't like the traditional IRA because, the whole idea that you can pay taxes, you kind of get hit with your taxes when you are older, when presumably tax rates may even be higher. I like the self-managed IRA, and within that a Roth. And I'm not giving you tax advice. You need to do your own homework, but learn more about the Roth and understand what it means. And in the meanwhile, I probably wouldn't buy long duration fixed income if I was this age. And there is a reason I say that. This may be, right now, 2024 may be a unique event where you do a yield barbell. But if I was 25, then, outside of the yield barbell, a small allocation, I probably wouldn't do that. I would take about a quarter of my investment amount and I would buy an index. And I say an index, not individual stocks, only because if you're 25 to 34, go have fun in the world. And maybe you can buy specific stocks that that you have firsthand. If I worked in the tech industry and I knew about a certain tech stock, I'd probably buy that. But I would leave a large amount of my equity allocation in an index. As you saw, an index performs just as well if you don't have time. And in fixed income at 25 outside of a yield barbell scenario, it just looks like not your cup of tea. Go have fun. I would tell my 25-year-old child to go enjoy their life, put some amount of savings in a stock index, and hey, have fun. As I get to 40, the kids are growing up and I got the minivan instead of the really fancy car and I got groceries loaded up there. And hopefully I'm still saving. Maybe I invest slightly more at that age. And in that scenario, I would again go through the same thing. I would put money in a Roth. And in this scenario, I would buy fixed income, but my target for fixed income should be that it pays at least for my rent and utilities, with the idea that if I put some duration in there, then I want to make sure that it pays for a portion of my monthly expenses. I would look at individual equities, but pretty much most of my money I would again put in an index. Now, whether you should put it in an index in Q4 2024 or not is up to you. But I would probably tell people, maybe there is an yield barbell, maybe a smaller allocation in equities, but make sure that if you're buying equities, the real yield, meaning if equities pay 3% and inflation is 3%, it makes no sense. So you better be getting a yield that is greater than inflation, and that is what I would tell a 40-year-old myself. What about at 55? As I start getting more and more buff as I age, it is clear that I'm eating the right stuff. And my wife, it is the same wife, even though Dolly, seems to change that woman in the picture. I'm sorry about it. Um, and at 50 to 55, again, I would hope I would invest, but maybe I'm willing to throw a little more of my income into investing. Once again, a Roth. Now I'm starting to allocate more and more into fixed income. And in that scenario, I would allocate, a good chunk, more than half of my portfolio into fixed income. And I would own some real assets. This would be homes. This would be, things that you can touch and feel and drive by. I probably would have some individual equities, and I am in the 50 to 55 bracket, so this is exactly what I'm doing. Eventually, I plan to put some of my allocation into an index, just not at this time. That is my judgment. You do you. Um, and once again, if the real yield is negative, then I will not own fixed income. So what about at a little bit of a later stage of life? And I hope to retain as much hair as this gentleman here, and my wife probably wouldn't like how she looks there. I'm sorry. But the idea here is by now you can't even have a 401k. You have a required minimum distribution. There are all kinds of things that kick in. Here, I'm allocating even more than 50. It's more like 65% fixed income. I would own a bunch of real assets and still have some amount of equities. But when it comes to equities, I would again see, do I know this company? Do I have reason to have really good information about this company? And if I don't, I would just put it in an index, seems to work fine, and I would again not buy fixed income if the real yield is negative. Here is the thing, sometimes the market may crash, and if it crashes, I would go buy more real assets. My humble opinion, now is not the time to buy, real assets, but the time will come, I hope. So that is my philosophy. Let me tell you what my trades are as I continue to be extremely fit as I age. I like what Dolly is thinking for me. Um, I am going through my instincts. When it comes to Black Swan and Force Pain, as I called it, you can see that I invest quite a bit in the extremely short term, and I will keep rotating that cash. However, make no mistake, I am investing both in the couple 3 weeks, and here is a 20-year agency, and that is a callable bond, but I am picking up duration. And it's a combination strategy of building the yield barbell. If it doesn't get called, I'll happily enjoy the 6% yield. But I do own some corporate bonds, BNSF, Merck, that are make whole call, that are 20-year terms. So I am playing both sides of the duration game. In terms of equities, there is really no surprise. It's the same pull tape, Bluebird, um, drone companies. And so if you kind of look at where my equity portfolio is in total, and I'll just leave it there for a second, you can see that it just grows like a meteor, 3.75% in a single day, 15% in the last month. And so equities are having a joyride lately, and I'm happy to ride along as long as on the way down, I don't capture a lot of the downside. This is a fun ride. So my equity holdings are no surprise to people who have watched more of this. It's essentials, it's monopolies, and it's companies that are profitable. And as long as I stay true to my philosophy, I'm able to make a very good return and match indices. That doesn't mean I can constantly repeat it. Make sure you check my work. Make sure you do your own research. And thank you for watching Yielder.